Following program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it is Saturday, and we have the answer about money. The radio station is called The Answer, and this program is about money. So if you look at the stock market, if you haven't seen, we're essentially in a correction. Over 80% of the stocks are in correction. They're down at least 10%. We've had some recoveries, some ups and downs. That's normal to be expected, but we're really in a correction. So what does it really mean? What's going on, and where is the market headed? Are we done with this secular bull market? Some people called it the longest bull market in history. Are we done with this? Are we through and we're going through another great recession? What's going on? We're going to talk about that later in the program. I've talked about it before. We're going to talk about it again. I have a guest today. You want to hear what he has to say? It has a lot to do with what's going on in Seattle and what's going on in a particular market. So we're going to talk about that. I want to ask, first of all, have you seen the new Wells Fargo ads? Actually, they're not so new. They've been running for a month or two. You know, Financial Advisor magazine also had an article. You know, the ads remind us of the role the companies played in America's history, the California gold rush, the kid from the Depression area at the bank counter. You know, what they have to say is they have always found a way until we lost it. But then the ad continues. That's not where this story ends. And the company's complete recommitment to you. You know, that's the ad. And does it bother you? It bothers me. It seems slick. It seems smooth. The language is smooth. But it seems to slide right past the problems. You know, I'm far from perfect. I make mistakes. I make quite a few mistakes. But when I make a mistake, I learn that the first thing I have to do is I have to admit it. I have to say I was wrong. Secondly, I have to really mean it. I have to say I'm very sorry. And then to finish, I have to say, will you forgive me? That's the way that I handle my mistakes. But when I think about that Wells Fargo ad, it seems slick. It seems like the language is almost so slick it's unbelievable. You know, it got me going as I looked at one of those ads. It got me going today on this radio program because they're a firm that fights the fiduciary rule. You know, the fiduciary rule that says make every decision in your client's best interest. They're a firm that pushes hard against that. And they have a real problem putting client interest first. It's the company interest first. And it's having an impact on their clients. We're going to talk about that later in the program. Just wanted to start that way. It's on my mind. You know, I also thought, as I was thinking about that, about a client that came in 2010. She was working part-time. She'd been to see a couple financial advisors. She had a fair amount in savings, but she didn't see, and none of the financial planners saw, how could she ever quit work? It looked like she was going to have to continue to work for the rest of her life. She had, since 2010, been starting to interact with grandkids. She was working 2 days a week. And she needed the income. She didn't have enough to take just the interest or the return from her account to replace everything that she had been making. She wanted to retire, but she didn't really have the funds to retire. So now we met this last Monday in the office, and her account has grown since she's had it with me to the point that her account now has grown enough that she has enough money to completely retire. She has enough money, she can spend it with her grandkids. She's always wanted to go to Greece. There's enough money for her to travel, to go to Greece this coming year, to make every year several trips traveling. She has the money to pay for that. She has time not only to spend time with her grandkids, but she has enough in her account. She said it would really make her feel better to pay off her condo. I said, the interest rate she's paying on the condo is significantly less than what she's earning in the account she has with me. But she said it would just make her feel safe once she winds down her last couple days of business, and she's a professional. It would make her feel much better just to pay off the condo. I said, go ahead, pay off the condo. Why not? If it makes you feel better, just go ahead and pay it off. And so I believe that as I'm talking today, I know the money was transferred out this past week. I'm almost sure that the money has gone to the bank, and she owns her condo outright. She's in the process that it will take her the next 12 to 18 months to wind up her business. But after that, she's completely retired. Something she thought would never, ever happen. I know that there are a few advisors that can do the same thing, but when you look at traditional financial planning and go through the process, there's just no way that you could have ever gotten it done that way. Anyway, those kind of stories really make me feel happy and make me feel like I'm doing something for my clients and my new clients. But that brings me to the question, because when she came to me, it was a secular bull market. We come from the bottom in 2009, March 2009, and we've had a very, very good bull market. So what does all this do? Now that we're in this correction time, it raises all the questions. Where are we headed now? And I think it makes some sense to think about where we are and where we're headed. I talk every 3 months or so, because I think you need a mile-high view to understand what's going on. I talk about the super cycle and where we are in that. I talk about the market and where we are in that. And I talk about how this whole thing ends. And I want to return to that because I think it's very important to understand. We can't predict how it's going to happen. Howard Marks says we can't predict, but we can prepare. And I don't believe it's too soon to begin to prepare. But it's also way too soon, in my opinion, to really convert everything in preparation. If you think back to 2005 and 2006, the movie The Big Short, a lot of people saw that the real estate market was going crazy, but they didn't really see that it was going to crash in the way it did. Very few did. Today, there's a lot of people that will tell you that they did see it. I lived through that. I can tell you there were very, very few people that saw what was going to happen. I didn't see what was going to happen. I knew we were going to have a financial crunch. I said that. I wrote a newsletter saying that in 2006. I said real estate prices were crazy and we could expect a crunch, but I never realized that we were going to have a crisis. So the reality is very few really see what's going to be happening and when it's going to happen. If you look back in the 1920s and 1930s, very few people saw that the Great Depression was going to happen. But our parents, my parents, grew up during the Great Depression. And that had an impact on what they did. And when my parents' generation came into power, they were willing in the 70s to inflate their way out of a recession to avoid a depression. The depression left such an impact, they were willing to do it. So the generation that grew up, and I was part of that generation that grew up during the high inflation days of the 1970s, my generation, as we came into power, were willing to do anything to avoid hyperinflation, including risking a Great Depression. We set inflation goals no higher than 2%, and that's where it held. So we went through this Great Recession. My understanding or my thoughts as we go forward, we're going to see a generation which grew up during the Great Recession and they'll do anything they can to keep from going through another Great Recession, including going through another high period of inflation. So when we talk about what's going on in the markets today in the correction, I think part of that plays into that. Part of that plays in because we're starting to see interest rates rise. We saw that. Interest rates were at 1% in 1962. They were at 2.9% by 66, 3% in 67, 5.5% in 69. A lot of people think about that high inflation time being because of oil prices going up. Inflation was already creeping up during the 60s. And in 1973, it hit 6%, just above what it was in 1969 and 70. And by 74, 11%. And you know the rest of the story. We ended up with a period of inflation, and not only inflation, a recession at the same time. I think some of those pieces are falling into place again. And it's not just going to be this year or next year or even in the next 5 years, but it's coming to that point. We're going to come to a commercial break. I'll return to this story after the commercial break. So don't go away. We'll be right back. Stay with us. And if you miss any of these programs, you can find it on YouTube. You can find it on our website. Pick up if you miss part of the story, if you miss all the story. Listen to us there. Be right back after the commercial.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about how the Great Recession ends. Something that I've talked about a number of times before. I'm talking about it again because I think you need to keep it in mind. I tell the story, it's the classic story of the frog. Drop a frog into boiling water and it jumps out. Put a frog into a pan of cold water and slowly heat it up, and the frog will just sit there until it's boiled to death. There's no truth to that story, by the way, but it makes a really good story. But it's like that for inflation. It just begins to creep up. And it started to creep up in the 60s. Everybody credits OPEC and the oil story with what launched high inflation. But it was high before that. It was high, and during that time, as inflation was creeping up, the chairman of the Federal Reserve was William McChesney Martin. He'd served under Truman, under Eisenhower, under Kennedy, under Johnson, and into the Nixon administration. But Nixon wanted the change, and he appointed Arthur Burns. Martin had been trained during the Great Depression. He had a seat on the New York Stock Exchange at one time. He came out of that mold, and he was concerned with the economy and with inflation, and he was starting to raise interest rates through the Fed to slow down the economy. But as Nixon was coming to re-election, he was concerned about the economy, and if the economy slowed down, he was concerned that he wouldn't get elected. So he brought in Burns, who was a specialist in business cycles, and Burns saw that we were entering into a recession. And so what he did was he started lowering interest rates from the Fed. And instead of interest rates going down, instead of inflation being curbed, inflation continued up, and when the oil crisis hit in 1972-73, inflation continued to take off. Now, there's not many people that look at today's inflation rates. The CPI is running around 2%. People don't look at that, increasing from 2 to 2.5%, or even almost up to 3%. They don't look at that in the same way as they look at 10% inflation, of course. But when interest rates are rising, it's a negative for the stock market. It has been, it always will be. and it begins to slow down, it can have an impact on the stock market and on the economy. And what we're seeing today is that wages are rising, commodity prices are rising, and we now have a significant deficit. We have a tax cut that will probably lead to a $1 trillion deficit. Now, during a really slow time, during the Great Recession time, deficits and government buying bonds and doing the things they did, that was pumping money into the economy, and it helped fuel the economy. But when your economy is running flat out, when your unemployment rate is under 4%, when you have commodity prices rising, you have wages rising, what that does with a deficit is it starts to push inflation up. If you look at wages, they're about 2/3 of the inflation rate. If you look at commodities, it's about 1/3. Those are rules of thumb. We're seeing both of those increase. And so we're seeing an uptick in inflation. But it's like that story back with the frog. It's going to take time for that to happen. It's going to take not months. It's not probably going to be more than years. But eventually we're going to reach the point where inflation is taking off. And if we have a recession, the look back, and most people look back to see how you deal with great recessions and recessions. The look back is to pump more money into the economy. What that did in the 1960s and into the early 70s is you had a recession and you had inflation continuing to grow. You had wages increasing, you had commodities increasing, commodities driven a lot by oil prices. You had both of those driving up inflation, and you had an economy that was slowing down. We had stagflation. I believe that we'll probably end up in a very similar kind of thing, thinking that we're preventing a great recession, which we will be, but instead creating a time in which we deal with a high inflation rate. It's a time to think about and be prepared. We go through corrections all the time. If you look at the last big secular bull market, 1982 to 2000, the Dow rose from 1,000 to 11,000. It was an 11-fold increase. But during that time, we had, of course, the October 19th, 1987 drop in the market. We had the 1991 recession. We had the correction. We had the 2000, not the 2000. We had the 1994 correction. We had correction times in between, but it didn't slow down the long-term bull market that went from 1,000 to 11,000. From March of 2000 until 2009, we had a real bear market. We had a great recession at the end of it. But now we're in this secular bull market. And I've been talking and do talk about Dow 100,000. I do believe we're going to get there. And I believe we get there before the period of the great inflation. That's coming. We're just beginning to see the very beginning. We're like that frog in the water, which really doesn't exist, but like that frog, we're sitting in cold water, but somebody's just turned up the heat and it's risen a couple degrees, but it's a long way from boiling over. That's where we are. That's something not to fear, something to be prepared for, but don't give up on the secular bull market. We've got a long way to go before that's over with. Anyway, that wraps that up. I want to introduce my guest today. It's Rick Parks from TRF Pacific. Welcome to the program, Rick.
Thank you, Mike. Thank you for having me today.
So let's start with your background. Tell us about your background.
Sure. Well, I am a 54-year Northwest native, grew up on Mercer Island. My family has been in my father, I should say, has been in the shopping center industry since 1975. I went to Washington State University and graduated there in 87. I spent about
And you went to high school at Overlake.
Overlake.
Don't forget
yes,
that. My son
yes,
went there too.
The Overlake School, the Fighting Owls. When I got out of college, I'd done some research work with Coldwell Banker, which is now CBRE. And so I started there and spent my first 10 years in commercial brokerage, most of it in retail, selling and leasing commercial properties. Did a little bit of work in industrial properties, warehouses, manufacturing, a little bit of work in office buildings. But the bulk of it was retail type property. Had a short stint in a marketing and sales position with a company on the east side called Pulsar Systems. Did that for about 2.5 years before joining TRF in 2000.
And TRF, part with your dad.
Yeah, well, he's had several partners over the years. As the company's gone through different iterations. He started in 1975 with Hank Gordon. They were building Kmart's back then. They also did the Factoria Square. That was one of their first projects, and the Safeway anchored Bear Creek Village in Redmond. And since then, the company and different forms of partnerships has done about 57 of these projects from the ground up.
So let's talk about what you're doing with TRF.
Well, my responsibility is leasing. And in leasing, what we're doing is we are filling vacant space with tenants, or we're renewing or maybe extending existing contracts, convincing people to stay in place for an additional term. That involves figuring out who the users are in the marketplace and matching up those users with the various vacancies that we may have at any given time.
So let's talk about the leasing and the cost of leasing and what's going on in the leasing market.
Right. Well, there's two sides of it. We are a developer, and so sometimes we are building. You have a cost-driven side, which can impact leasing, because if it costs too much and the market can't cover that cost, then you don't have a project. The other side is just simply the demand for space. If you've got enough users, and then you can fill the vacancies. If you don't have enough users, then you can't fill the vacancies.
So what's happening with cost right now?
Well, costs are running. And I can tell you in our last project, they ran 30% over the course of a 12-month period.
When you say running, what do you mean?
I mean, if you start at $10 million, you finish at $13 million. I don't know if I did that math right, Mike.
Yes, that is.
But that is a huge increase in cost over a 12-month period. But basically, during the entitlement period to get the right to do what we wanted to do, the original number that we sat down with had grown 30% in cost. That was an increase in 30% over a 12-month period.
And that has a significant impact.
That has enough of an impact that you have to go back and talk to the folks that are going to use the property and talk about, we either need to have a little bit more rent or we're not going to have a project.
So we're going to come back to this right after this commercial break. We are coming to a commercial break. It's an important part of what's going on, and understanding with all the things going on in real estate with the number of cranes. You see that in high rises, but we're also building smaller malls. We're building smaller facilities. You need to understand what's going on, and that's what this program is about, is to introduce you, the listener, to what's going on around us and in the different markets. It's really important to understand what's going on in the leasing market. We'll be right back after this commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm here with Rick Parks, the principal at TRF Pacific. We started talking about leasing, and cost for new projects is going up. No big surprise. If you've been listening to me, you know that wages are increasing, commodity prices are increasing. So the impact of that, however, is something that you also need to understand. So back to leasing. If costs are rising, that puts a real limit on what you can do for a given fixed price of leasing, right?
That's correct. So these projects and the kind of projects we're in our grocery store neighborhood shopping centers, they're called daily needs type of properties. And you can't do these projects unless you can entice the investors and get the construction financing and then eventually the permanent financing. And you can't do that unless you hit a threshold of return on cost. And so what happens when the costs run really hard or when they increase is you get to a point where you can only charge so much money, so much rent in the market, and those costs begin to get too high, and then you can't generate enough rent to get a return that's commensurate for the risk that these people are taking. And so what happens is you slow down your development or you don't develop.
And when you don't develop, then what does that do to the rest of lease prices elsewhere?
Well, it really, again, it depends on what the demand is for the space. If you've got a lot of folks that need storefronts, then in our business, what will typically happen is the rents will simply rise in order to meet that increased cost, entice the investor and the developer to come in and get the project entitled. It's a very capital intensive business, real estate, and it's very risky up front because you don't always know with the city or the municipality that you're working in if you're going to be able to get the permits that you need in order to build what you want to build.
So there's a lot of talk about the internet and sales going off on the internet having an impact on retail. You get to see the retail side. So tell us about that and the impact you see.
Well, it's interesting because when I listen to the media, I would think that I shouldn't be in business anymore because retail, you would think, is an extinct or going to be extinct business. The internet actually is about when you include the actual physical store, those folks like Nordstrom who are also selling on the internet, we call those omni-channel players. When you add all those folks together, they have about 7, maybe 8% of total retail sales in America. When you strip away the stores and you just have pure internet catalog fulfillment type companies that are taking an order and delivering straight from a warehouse somewhere that you never see to your front door, that lowers it to about 3%. So I think, there's 90% left of the retail market out there. And I don't think Nike and General Mills and a lot of the manufacturers are ready to turn over all of their production to that 90%. But we do need to remember that the retailer is operating on a smaller margin, maybe 3% for a grocery store, maybe 6%, 10% for a restaurant. And so as the internet creeps in, it does impact that margin, which is pretty low.
So you do a number of leases for grocery stores, and there have been a number of attempts going back to 2000 and current attempts for the internet players to actually do internet grocery sales. You've had experience with that. Tell us about that.
Well, the internet struggles with what we call the last mile. And the last mile is really that last mile to your front door where you live, Mike, or any other consumer for that matter. AOL was struggling with this 20 years ago, back in the late 90s. They admitted that the Achilles heel in the model was, what do you do in the last mile? How do you get those goods to the store? And the problem is that the consumer today drives to that grocery store that's in the last mile. They do the labor of choosing and sorting and picking the groceries. Then they take it through the cash register, and then they take it out, sometimes with a little bit of help, to their car, and they take it home to their front door and put it away. So that last mile is tricky. And I have one grocer friend who talks about if he has to go use his labor, take an order off the internet or the fax machine or the phone, go into the store, pick it, put it in a bag for one bag, and then deliver it out his front door to the trunk of a car, that's $15 in labor. Now, if the bag of groceries is $100, he's got a margin of maybe 3%. And so that is the part of the last mile that everyone's trying to figure out. What do you do about that $15 cost?
So the reality is it's unlikely that we're going to see grocery stores replaced by the internet. That's my feeling. I've been saying that for a long time. But
I agree with you, Mike. I'm biased, but I must say, in the time I've been in this business, retail is constantly reinventing itself. So it's, in my opinion, especially in the last mile with the daily needs, it may change what it looks like, but it's still going to be there in its form of a physical store. Will they be flying drones off the roof? Maybe. Will they be delivering from that store out into the marketplace to your front door? Maybe, if you're willing to, if they can figure out how to get that cost, maybe you pay it because it's more convenient to have them brought to your front door. But it's really hard for me to see that well-located physical stores are going to go anywhere in the future. We might change how we do it. It might look a little bit different, but it's still going to be a store in the last mile.
And there are internet services where you can hire somebody that will do your shopping for you, pick up and do all the sorting, pick up your groceries, and deliver them to your house. But as you say, that's an added expense.
Well, if you and I were going to go into business, Mike, and we were going to be in Sammamish, let's say, would we want to go to a store in Sammamish, or would we want to go to Kent to get the stuff and bring it back and deliver it? I think the business model is still pretty good for a physical store in the last mile.
It sure is. And not just grocery stores, but in a lot of retail stores.
Yeah.
But there's no question also that certain things are being sold retail on the internet. And companies have to reinvent themselves. No more clear than a company that filed for bankruptcy this week, Sears.
True. The Sears is a very interesting case study. They invented the catalog business.
Yeah.
That was the big Christmas catalog that you and I talked about earlier. The key is, and I think maybe a lot of people don't know this, but in 1978, when Sears was at its height of commercial stores, its catalog business still provided the lion's share of the revenue. Now, there really isn't any difference between a catalog and the internet. If you want to think of it, you could think of a catalog as kind of an analog system, while the internet is more of a digital system. But it's still, one's a 8-pound catalog and it's got 500 pages in it, and the other one's a nice little iPhone that you can carry around in your back pocket, but it's still kind of the same thing. And they just didn't make that switch to digital, I guess.
They didn't realize that was going to happen.
Yeah.
So we got to see the change that's going on. But that, when you talk about the leasing market, there's still a significant amount, but there's changes that are going on. Where do you see the future of leasing going?
Well, from a physical standpoint, you mentioned this earlier, especially in the larger format stores, Ross Dress for Less, some of what we call the old category killers that we would see in power centers. Those stores are coming down in size a little bit. You're seeing a little bit smaller size. They're getting the units, the SKUs that sell the best are going on the shelves, and then some of the stuff that doesn't sell as well is relegated to internet sales and isn't actually in the physical store. So you're seeing the physical store size come down a little bit. in the overall shop space market, you're really still 20 feet of storefront by 60 feet deep. So the 1,200 square feet at the small end is holding pretty well. That's pretty much a constant.
So I want to thank you for being on the program. If someone wanted to contact you about leasing, how would they get a hold of you?
Well, they can reach me at 206-985-0107 is my direct line, or they can reach me at rickparks@trfpac.com.
And tell us about the website.
The website is trfpac.com. That's www.trfpac.com.
And they can see some of your customers. They can see some of your services.
They'll see
Right
they'll get all of our services. They'll see all of our projects and various partnerships that we've put together in different forms of real estate development.
Well, thanks for being on the program. And it's a great insight into what's going on in your market.
Mike, thank you. And I hope that I was able to give your listeners something.
I think so. We'll be right back after this commercial break. Don't go away. I want to return to this story about Wells Fargo finally. We'll be back right after the commercial break.
More about money coming up with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I started the program talking about Wells Fargo. Remember 2 years ago, Wells Fargo was in the news? 5,300 employees felt the pressure to sell checking accounts, credit card accounts, home mortgage stuff. They opened bogus accounts. People ended up with credit cards they didn't ask for. And oftentimes they ended up with credit card charges that they ended up going to collection for. They ended up with checking accounts they didn't ask for. 5,300 first-line employees were fired. It took a while. John Stumpf was the CEO, and he testified before Congress. And they asked him what he was going to do, and he thought firing the first-line employees was enough. Well, it didn't turn out to be enough. They got rid of him. And now they have new ads out. I talked about those ads. They're so slick, they're so smooth, but they really never, in my opinion, address the issue. It's never been a question of, we really made a mistake, we're sorry, we want you to forgive us. No, it's been, we were a great company, we made a couple mistakes, but we're going to go on and we're going to do well. Well, the whole fact is, it's a culture of sales. I came out of the big brokerage houses. I spent 18 years in the brokerage houses, and the whole focus is on sales. It gives you some insight. During the Great Recession, coming out of the Great Recession, one of the things that Congress wanted the Securities and Exchange Commission and the Department of Labor to do was to come up with a fiduciary standard. To me, it seems really simple. A fiduciary standard should be one sentence long. Every decision is made in the best interest of the client. When the Department of Labor came up with the fiduciary standard language, it was 800 pages long. I go to the National Association of Pension Advisors conference, and I sat in the room with the people that wrote a lot of the language. It was most of the pension fund advisors that wrote the language, and most of the people that were the organizers of that group were from the big brokerage houses, from Morgan Stanley, Merrill, from UBS, from Wells Fargo. They were the ones that wrote the language, and yes, it was an improvement over what they were doing. But instead of being straightforward, every decision is made in the best interest of the client, instead it was 800 pages long. They wanted disclosure. They wanted level fees. They wanted a best interest statement. But never was it that one sentence that said every decision made is in the best interest of the client. I worked for Dane at one time. And they came out with recommendations for a bond called Boston Chicken. They put this out to 900. And Dane at that time had just under 1,000 employees. They put it out to 900 brokers. And the analyst who did it made a mistake and left out some of the debt that Boston Chicken had. I usually do my own research. I always do my own research, except in one or two instances. And in that time, I was at a conference in Houston where the analyst took me through the finances he had developed, and it looked like it was almost a slam dunk. Well, it didn't turn out to be a slam dunk. I didn't take the time to look at the offering statement until Boston Chicken filed for bankruptcy. And it was me that made the recommendation to my clients. When Dane said, "Oh, it took us by surprise." Now, the right thing for Dane to have done is to say, "We made a mistake. We're sorry. We're going to make it right for the clients. And we're not going to do it again. Please forgive us. We're going to make it right." That's not what they did. Instead, they said, "Oh, we were taken by surprise." I said to my clients, you have the right and should litigate against the company. You should sue the company. The company didn't like me for saying that. I left the company. They really didn't like me for saying that. But my clients got 75 cents on the dollar. They were the only clients out of thousands that got a settlement and got almost, when you added one or two interest payments in, they got almost the money that they put into it. That was the way. The company made its decisions in its best interest, and it builds a sales-focused environment. I spent 18 years. If it depended upon what kind of gross production you brought in, there were special designations, the titles. If you produced a certain amount, you were a vice president. If you produced a little more, you were a senior vice president, associate vice. Now you began associate vice president, senior vice president. I was a senior vice president. If you produced enough, you were part of the president's club. At Dane, if you were part of the president's club, once a year you got to make a trip into somewhere like Napa one time, Disney World one time. But the second, if you produced even more, you got to be part of the chairman's club. And there you got an international trip. I went to Amsterdam, went to Madrid, went to Cabo, all those things. None of those are in the best interest of the client. Why is sending someone to Amsterdam or Madrid in the best interest of the client? Why shouldn't that be a focus on the client, not the broker for a good time? In the last 2 years, over 1,000 financial advisors have left Wells Fargo because of what's going on and the pressure to sell. Their financial advisor workforce is down to 6.7% in 2 years. 152 advisors left just in the last quarter. That in the second quarter. The CEO on their conference call said that they are really seeing more loan origination and growth in the book of business. Loan origination. Financial advisors are not growing accounts. They're creating loans for their clients. I thought that was really interesting. They don't talk about improving investment performance. They talk about making more loans. They're talking about growing their book of business. I don't know if you have a Wells Fargo account or if you have had a Wells Fargo account. The question is, what are they really doing for you? Are they achieving what they should be doing? It's a top-down sales culture and goals. And when I say that, it's not just Wells Fargo, it's Merrill, it's UBS, it's the big brokerage houses. The focus is not on you. It's on their own growth and selling their own shares to the shareholders. The question is one of fiduciary. Whose interest are these decisions being made in? Not yours, that's for sure. If your objectives line up with the company's objectives, it's the same. But if they don't line up, it's in the company's best interest that they make those decisions. 1,000 brokers have left, 1,000 in the last 2 years. Most of them have moved on to other big brokerage firms, and they got paid a big chunk of money to make that change. That's the other thing that goes on, is brokers get paid a big chunk of money to move from brokerage house to brokerage house. And I did that a couple times, so I was guilty as well. But that's not in the best interest of the client. The best interest of the client is to find somebody that can really produce, who can give you the performance, who can grow your account as it should be grown. That's what makes sense. It's not the question of those firms whose big mantra is sell the relationship, not the performance. Make them like you. Make them really like you. Don't worry about how well you do for them. They just want you as your friend. Anyway, that wraps up today. I will be back next week with more insight into what's going on in the markets. Have a very great weekend and a week. I will be talking to you then.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program is for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.